S&P, Michael Myers, talking about the S&P climbing to a record high after this week, fueled mostly by bank shares. The Dow also up over 3%. Its best week since back in mid-March. Joining us now for his take on the latest market trends is Barry Knapp, Ironside's macroeconomic managing partner, director of research. Barry, you're Fed focused. You're Fed obsessed, I would say almost, but also got your eye on this infrastructure kabuki dance that we're seeing also. But let's start with the Fed. You think that there's been a hawkish pivot that they didn't try to push back against? Is that bad?
Well, ultimately, these uncertainty shocks that we have when the Fed starts normalizing policy are not terminal for the bull market. They're not terminal for the expansion, but they're a pretty big deal. This was my framework for the whole year, was that we would not have a significant correction, anything bigger than 5 or 6% or so, until the Fed started cutting back on the asset purchases. Once that happened, we're likely to get a decent-sized pullback. And one of the things that's changed since the period before the financial crisis to after the financial crisis is the Fed's involvement in the mortgage market. Because of their involvement in the mortgage market, they suppress volatility in a very significant way. The single biggest source of volatility in the Treasury or interest rate market is mortgage prepayment risk. Before the crisis, rates would fall, people would get would prepay their mortgages, the holders of those bonds would lose their bonds. That would cause, the move to get exacerbated either up or down in rates. So prior to the financial crisis, the typical Fed-related pullback would be 8%. After the financial crisis, it was more like 14. And the biggest pullbacks came when the Fed had been buying quite a bit of mortgages. So the end of QE1, QE2, and then the balance sheet contractions in 2018. The Fed does need to get out of the mortgage market, no doubt. But I think we're going to have a significant pullback and shock higher in rates when they do that. And part of the rate story, as you alluded to, Joe, is related to the infrastructure program, because that was the catalyst for the move higher in rates in the first quarter. Not growth expectations rising, not inflation expectations rising. It was really all about the Fed borrowing an extra $1.9 trillion that the market wasn't expecting. So when they get back to that point, and they will, whether it's directly tied to a bipartisan deal or not, they are going to borrow more money, a significant amount more. We'll get a move in rates. And so there is probably a decent risk-off episode coming, within the next 1 to 2 months. And that, investors need to be prepared for that.
Well, the biggest fear is that, that there really are 3 mandates. And the third one, although they may be kind of ignoring the price stability mandate at this point for full employment. But the third one is to keep everyone happy in the stock market, maybe. It's just sort of an implied one. And they're very loath to rock that boat. But if you do the first infrastructure, and then if this family plan, which is, I don't know, is it $6 trillion, whatever they're trying to do, but you're not going to be able to have, if you're borrowing that much money, the Fed has got to be your partner. It's got to be the partner of the Democrats and the Biden administration in funding all that spending. And you can't fund it if rates are going up. So that's the ultimate roach motel that they can't get themselves out of, because you're not going to have the opportunity to raise rates. The further they go along, aren't they getting more and more sort of stuck?
They are, and I think that's right. Once we get past this first normalization shock, where they try to start getting out of this policy, they find that we get a fairly significant risk-off episode. The Fed will be behind the curve through this cycle. And, Bill Martin, who was president or chairman of the Fed back in the 60s, used to say, the Fed is independent within the government, not of the government. So ultimately, they funded or financed Johnson's Great Society and war in Vietnam. And I think the same thing will occur. That's part of the reason why, when I told people to reduce risk, I didn't say to get out of all those reflation beneficiaries, because this is very much like the 1960s. We've got expansive fiscal monetary policy. We're losing interest in being the world's reserve currency. The Fed is ultimately going to have to finance that spending. They work for Congress. And so I do agree that that is going to be the theme of this business cycle. It's part of the reason I am in the, reflation. This is a different inflation regime camp.
Yeah. All right, Barry. So you're out there, huh? Are you in greatest summers and maybe on the planet occur in Colorado, don't they?
It's been fantastic, Joe. Golf out here is nice too. You'll have to come play sometime.
300 days of sunshine a year, no humidity. Boulder was really. I mean, you would live there. Well, you do live there, so.
I do now.
Okay. All right.
I'll come back and see you though.
And you did.
Yeah, and I did. Now I live in New Jersey, but it's a Garden State.